All right, good morning, everybody. So hopefully everybody's okay after the storm. Some places are actually still getting a little bit, like some dust up. It's FOMC week, so the possibility of a hurry up and wait mode on Monday and Tuesday is very likely. That means it's really possible we don't do a damn thing for 2 days. But there is always the possibility that we expand on the first day and then kind of top it off. It's quite a mess out there. Japan down more than 0.5%. Small caps, NASDAQ down less than a quarter. Europe barely up. So it's a mixed bag for sure. More delayed data, some durable goods, transportation, that sort of stuff. These numbers are really far out, but with it being a delayed report, it's hard to say how much impact, if any, this is going to have. But when you see this sort of discrepancy or numbers that are this far apart, just pay particular attention to what's going on. It does say November there, right? So, like how much is it really going to hurt? Still, those numbers are really far apart. So just, mind the clock, keep your eye on it. We got some auctions today in the front end. I mean, these aren't the ones that I deem, the most impactful, but we don't turn away data. So, the auctions are coming. Keep your eye on the clock today. See if we witness any impact from that sort of flow. It's all in the front end. You could probably just use IRX. And remember that the 2-year, well, I mean, the Fed can only control the front end, right? There is a lot of talk about intervention in Japan and the possibility that this intervention will be done with the help and support of the US. It's not the first time. I believe it was 2022 during that whole bear market fiasco. I keep wanting to think it was October, maybe November, when we seen that same coordinated Japan US intervention, and it was magnificent. So we'll see if we get something like that again. That is the rumor right now, or at least the whispers, the shenanigans. With the auctions today in the front end, you could keep your eye on the FedWatch tool. This is a free website. Just type in FedWatch and you'll find it. It's the CME group. Once you scroll down, you got the various FOMC dates here, and you can then choose your date and see what they're doing. Is the market pricing in a rate pause, a rate cut, a hike if you go far enough out? Who knows, right? That's the idea, is you could come in and see. So after the auctions today, maybe come back in and see how the market takes those auctions and what they're reading into it by what they begin to price into the market. It probably won't be the March one. If we see any moves in here, it's likely going to be for April or June. Who knows, right? For FOMC this week, it's already a done deal that we're not going to get a cut, right? Nobody's looking at this meeting for a cut. What they are looking for is guidance. And that's going to be a really big deal, right? So we can't anticipate that guidance. We have to hear it and see what they have to say. Are we going to continue with the hurry up and wait mode? Is the number of cuts projected for 2026 on the table as a possibility of changing? How many more could we get? Those sort of things. So the rhetoric that we get Wednesday is really going to be the key to all of it. There continues to be a lot of talk about the repatriation and how money's not going home. Money's going into gold and silver instead. It certainly took off again. Silver and gold on the run this morning. So with a slow week, it is absolutely possible that we just don't do anything, right? And that's what we really want to focus on, is the likelihood that we just stay sideways Monday and Tuesday while we wait on data. Now, there's plenty of FOMC weeks in the past where we did not go sideways, that we actually broke out and ran on that first day. And then Tuesday, we kind of completed the move and then, came back into Monday's range and waited for FOMC on Wednesday. So it's absolutely possible that we can break out. Never discount price and think that it can't do something, because price can do whatever the hell it wants. And if you haven't learned that yet, well, stick around, you will. But the base case argument is that we're going to hold the line and go sideways into FOMC. And so until that is proven wrong, that's what I'm going to run with. We did break outside of this inside day pattern. We were going IX10 if we opened today inside this box, and we didn't, right? We gapped down onto the 50 and then opened up there, fell underneath it. Now we've rallied back up and we're back inside the box. A lot of people that mess with the inside day material would discount all of this because we were outside of the box. And if you're looking for, purity and compression, then sure, this certainly has broken that. But if we close inside this box, then we're still in the thick of it, and it's still going to need to be resolved. So we need to focus on getting out of this box. How we close today will, give us some insight on that going forward. There was something else that I was looking at over the weekend, and it really comes down to how you count this right here and whether or not you count it at all. So we've been getting higher highs and we've been getting higher lows. And then we got this situation here. Now you could argue about that too. It's certainly on the table. We're in this transition period, and it's muddy enough that it could be considered a complex topping pattern rather than what I'm highlighting here as a lower low and a lower high. Since we gapped down and we've already run up, all of this doesn't count yet for a lower high. If this candle turns red today and we come back down and the whole thing is red and it just leaves a long wick behind, and we close somewhere down here, then yes, this will be a lower high. But we haven't done that yet. If we close anywhere inside that box that I had drawn, then it's not a lower high. It won't count yet. It's a really big deal whether or not it's going to be counted yet. we could see the beginnings of a transition down. That downward transition leads into a larger perspective of uh, a 2026 where we are struggling and fighting to get back up again, and we don't get back to these highs into the October timeframe. It's pretty radical, right? It goes against everything that we've been focused on for the last 6 months. The thing is, we can get stuck in a period where we set this tone and we set this high, and then we're stuck in it for months, right? Where we just don't do anything. So it always starts somewhere. Right now, we want to focus on this 69.60, 69.80 area. We want to focus on this high and this current move, and the half back of that move, and whether or not we're going to fade away from this zone and retest this low, which will make, without a doubt, this a lower high. Once we start setting that up, if this does become our lower high, then we're going to be looking for a full set. That's 2 lower highs, 2 lower lows. That's a full set. Or, if we were headed up, 2 higher highs, 2 higher lows, that would be a full set. So keep your eye on the 50. Breaking back down below that does offer us the low. It was an impressive recovery last night, to say the least. When we gapped down in the overnight and was able to recover the gap first and then digest all the way into Europe, and then finally got that expansion. We got it, but we're already losing it, right? We got the unwind here, a liquidity gap, which we've closed that liquidity gap already. So we closed the big gap. We closed this liquidity gap. It doesn't owe us anything more. And at this point, we want to just stay inside of Friday's range and not give up anything else. I think it's very likely if we get back outside of Friday's range that we're going to give up more than that. 69,000 in the overnight. Not a lot to that. It's certainly decent volume, but not extreme. When things got more negative, as you can imagine, we had a lot more volume during that negative run back here. So even with that extreme move, we didn't see the increased negative volume on it. We did test the 10-week last night. It's basically where we opened up. Down here is the 10-week. And we managed to hold that level and rally back up. But if we snapped a Linreg line, the direction there is clear since Thursday. So to turn that around, we would need to break our own Globex high, get above that, get through the volatility trigger and Friday's high, and start pushing above last week's high. It's not looking good. But if you look at all the tools out there, all of the various market breadth tools, there's no indication that we're ready for some big downside move, right? Doesn't mean we can't get it, just that it wouldn't be from, like the Mag 7 and that sort of stuff. It's going to be from something else. All right, we made it to one side of the ADR early enough that implies we can go to the other side by the end of the day. Now, funny enough, we almost made it to both sides. And it's not the first time we've had such a situation. Close doesn't count. We didn't actually get there. But we basically went from one side to the other. Well, there is no doubt that we did get here. We were able to get above it, but we didn't keep it. And now we're back above it again. It's unusual to get above it and lose it and then get back up there. That's unusual enough all on its own. But the fact that we have done it now really kind of implies, look, if we get back underneath this thing again, it's very likely that we can't keep it. And then that phrase is still in effect. So if you get to one side early enough, you can go to the other side by the end of the day. That wouldn't make us bearish. That would just be price forming that wave that it does, right? It's just what price does. So if we break 23, then, you know, that's where we're headed. You could divvy up the Globex price, lay it out into the quadrants like we do. There's your mid at the 14. You could just focus on the low of yesterday. Or the ADR line itself. There's a cog line in there called the 32. So underneath the 32, test the low of yesterday. Underneath that, test the half. Under that, we're going to the low. Under that, we got the full ADR. You get the idea. Level by level by level. And I would pay particular attention also, if we do get down into these lower regions, to focus on where we opened last night. That 6 o'clock open will be another level. Of course, there's 92 cog line down here. There's an 11 cog line, but that's close enough to the 15 that we can just call that one. So we do have some downside levels. To the upside, get through our own Globex and challenge the full ADR, which is basically yesterday's high. And above that, we'll look for 111 and 1236 and a reversal back inside again. I'm not looking for a big move above yesterday's highs. We could get it, absolutely, but that's not the base case. If we do get it, then the target is the weekly expected move edge, because too many FOMCs, we've seen price make it all the way to the edge of the weekly expected move on Monday. So while my base case is not a breakout, I will play the reversal. And if that trade loses, that's fine. It'll be a small loss. Take my hand to slap, and I'll take the other side and run it to the edge of the week. Today's floor pivot is basically in line with yesterday's floor pivot. That isn't bullish or bearish. Price opened underneath it, which is really bearish, but we've already come up, interacted with it, and now we're basically on the pivot. There's not a lot of value to that one way or the other. We were underneath the weekly pivot, but we're back above. Generically speaking, we're bullish the broader market when we're above the weekly pivot, bearish below. So, you know, for what it's worth. We didn't have much of a move on Friday. So the S&R lines should be relatively narrow. That's R1 and that is S1. Now, technically speaking, we went to S2 last night because that's where we gapped into. And from there, we've come to the pivot point. It does put R1 on the table, which is this level here, 69.57. And above that, we've got R2, 69.80. So we do have some upside targets. Otherwise, failure to hold this floor pivot channel, a breakdown of that channel offers S1, which just lines up with all the other levels we were already talking about anyways. So it doesn't really offer anything of value at that point. Last week's profile doesn't really have a lot to offer, but that point of control at 69.50 does reaffirm the 50s that we're using, and we're underneath that level. If we could get above that level, it might offer some structure, but we have to get there first. And it's not just that level alone, it's everything that helped build that level out. And we're in it. So as long as we're holding above 25, then we're still within this volume shelf. And if we lose that shelf, it gets really thin and doesn't look like we get any sort of help until we get back down into that 68-70 range. There's a lot of footprints around that 70 range from back here. But the main one that I have been focused on is this one. We pretty much destroyed that level last week. That's why it's not there anymore. But that was the last one of value that we really had. Now I suppose if we're looking for a new one, there's this 67.80 if we just want another round number. So instead of 68.80, it's 67.80. We'll see if our value area low offers any structure, but I wouldn't put much faith in it. $10-day, 30-minute volume profile and TPO got a little disagreement between these two. Throughout the week, this week, we're going to eliminate these candles that are over our head. It's going to thin the profile out up there. And unless we break above last week's high and put some new candles in up here, then as the week goes by, we're going to thin this thing out a little bit. And that's what we would be looking at if we maintain last week's range by the end of the week. We don't have a new home for the point of control. Even the candles that made this point of control, we're not going to even start to get into those for half a week at least. So the only way that we're going to see this point of control move right now is if we build out a new area and drag that thing out of that spot. And we don't have any spot right now that it could go to. In fact, we are adding more candles at that location right now. So it's very likely that the change we see this week is that TPO comes down to match, and we just reaffirm this 69.40 area as our point of control for another week. We had a VPOC from Friday, but that's been hit. We're done. We don't even need to mark it. The textbooks would tell you to do it anyways, right? The textbooks say carry these 3 lines forward every day. I've got enough pivots, so I don't do it every day, but that would be the value area high, the value area low, and the point of control from the previous day, right? Not my cup of tea. I don't do it. But if you don't have enough pivots and you want some more, those would be 3 really good common pivots to carry forward. Since we already hit that level, it's not a VPOC. I have no interest in it. I'm not going to mark that level out. Nothing really stands out in today's profile other than the classic P shape with the distribution across the top with the point of control. Now we'll just have to see what comes out of it. All right, so last week we had a preview of what this week would look like, but it wasn't set in stone when we were looking at it Friday morning. Well, now it is. It's locked into place. It won't move again. And we can take this week's range and we can compare that with last week's range. And it's just a little bit bigger. Well, it should be bigger. We got 5 days this week. It was a 4-day week last week, right? So just because we have 5 days, automatically it should be bigger. The math that makes this range has volatility in it and time in it. So if we're comparing a 4-day week to a 5-day week, obviously we can travel farther in 5 days than we could in 4 days. So the range is a little bit bigger simply because we have more time. But it's not significantly bigger. They didn't pump in a bunch of volatility. And that makes sense because it's an FOMC week, and FOMC is volatility suppressing. I know. If you're hearing me say that and you've never heard that before, you're probably thinking I was dropped on my head a few times, which I don't think you're wrong. We call it volatility suppressing because as we get closer to FOMC, the markets will start to go sideways. Nobody wants to front run FOMC and second guess what the outcome may be. They just sit on their hands and wait for FOMC and then trade whatever outcome we happen to get. So big events, CPI, PPI, non-farm payrolls, FOMC, they are volatility suppressing. If the market begins to price that in, they force this narrow range week because this range is based on the trades they actually put on. It's not based on technical analysis or some interview where they said what they were trading. It's based on the actual trades that they placed in the options for this week. Right? What do they say? Follow the money? Well, that's exactly it. Follow the money. It's not as narrow as I would have liked it to be. So they're still pricing in some outside volatility. We have the Mag 7 earnings this week. There's all kinds of stuff, right? This shenanigans with Japan and the possible intervention there. There's all kinds of other volatility out there. But FOMC is not one of them. And the range isn't as wide as it could have been. So it's not a really clear hurry up and wait week like we would normally get, but it's not a big wide expansion week either. It's muddy waters, and that sucks because I'd rather have something solid and definitive rather than the wishy-washy kind of sort of maybe that we ended up with. But that's what we got. I mentioned it earlier, but now that you have the visual, maybe it makes more sense. If we break above Friday's or last week's high, which is that level right there, that green line is the target. today, 70.32 cog line. So we're talking about from 69.75 to 70.25. It's 50 points right there. Add another 8 on top of that. It's 83 points. Surely somewhere in there you could get 5. And I'm not talking about to the tick either. We could get just close to the line or near the line. We don't have to necessarily get all the way to the line, to the tick. But I think we'd get pretty darn close. There's a lot of FOMC weeks where we did exactly that. Although I guess the opposite could be true in the other direction. So let's run that scenario. If we break back down through our own Globex low this morning, which let's just call it 80, we can go to 20. It's not as good. It's only 60 points, but you know, what's 60 points among friends? You can get the whole week's work of trading done in a single day and just call it quits. All right, we're still above the 10 week. I still haven't got my reset. Maybe April, right? Maybe April. So this sort of downward spiral continues. We didn't put in any work down here. It's fine. We're holding the line. But we're really close to the 10 week and we can get stuck at that thing and it can just kind of hold us here. So, you know, we're still looking for the catalyst that's going to get us away from this 10 and help us expand. And right now, the biggest catalyst is Wednesday and it's only Monday. We got a lot of examples of these small dips below the 10-day and then moves back up. The concern is when we get under there and we stay there, right? That's when things start to get nasty. So we've spent a few days at and around that level. The concern here is that we start to give up this range and we expand back down. We are not oversold. We're not overextended. We haven't moved too far too fast, and it doesn't owe us anything. We're basically in the center of the court, and we could make a 2% move up or down, and we still wouldn't be overbought or oversold. Not from this starting location. So unfortunately, we don't have any edge. We're not leaning on anything. China's down, chips are down, UFO, Bitcoin. You know, it's not everything that we would want for a rally day, but if we had all of those to the upside, we'd definitely be looking for a rally day, and we don't have not even one of them. Right? Finance is down, but not enough. So, you know, keep your eye on that. Be looking for a 0.5%, which is the benchmark. Looking at what's up this morning. What's gold miners, uranium, metals and mining, nat gas, energy, generically speaking, energy. Like we got nothing, right? A little bit of bonds, a whole lot of nothing. So if we do look for a rally day today, then that's what's going to need to change, right? I mean, not necessarily. Could we rally without them? Yeah. We could get some 0-day flows just coming in, you know, a rising tide washes everything out, get the indexes to push. It's absolutely possible, but why? Why would they come in and run the indexes on a day like this and front run FOMC? Absolutely no reason to do it. So if we don't get that, then we would need, you know, like the Mag 7 constituents and those guys to be the rising tide. But why the heck would anybody jump in front of the Mag 7 on their earnings week? Right? Doesn't make any sense. So don't really expect that to happen. What else would be our driver for a rally at this point? If it's not the Mag 7 and it's not the dealers pushing the indexes on their own, that leaves, FX markets and that sort of stuff. All right, so keep your eye on Japan. Well, we were already doing that anyway, so that's not going to be really helpful. But that's the base case, right? Keep your eye on the FX markets, watch Japan. If there's going to be a trigger to the upside, it's going to come from that direction. At this point, anything could send us to the downside. We've already got enough negativity in chips and the Mag 7 and everything, all the growth stuff that we would want. It's already negative enough, Bitcoin, that if it starts to get too negative, that's just going to cause a knee-jerk reaction and send us back to the upside. So I wouldn't look for that to get any more negative. I'd just look for it to hold the line. So you got the levels. It's a pretty simple gift, I would say, all things considered. It's supposed to be a sideways day. I'm going to trade that. And like I said, if it's wrong, if we don't reverse off the edges and come back in again, then trade it to the edge of the weekly expected move, because that's what we've done in the past when we've broke out on a Monday, up or down, of an FOMC week. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.